One committee of 12 people controls the cost of borrowing money for the entire American economy. Their decisions ripple across every mortgage, every car loan, and every stock price on the planet. That committee is the Federal Open Market Committee, the policy arm of the Federal Reserve. The Fed is America's central bank, created in 1913 after a series of devastating bank panics. Its core job is deceptively simple: keep prices stable and maximize employment. This is called the dual mandate, but achieving both at the same time is one of the hardest balancing acts in economics. When inflation runs too hot, the Fed raises rates to cool the economy. When unemployment spikes, the Fed cuts rates to stimulate growth. It's a constant tug of war. The Fed's primary weapon is the federal funds rate. This is the interest rate banks charge each other for overnight loans. It's the most important interest rate in the world because every other rate is built on top of it. The FOMC meets 8 times per year to decide whether to raise, lower, or hold the federal funds rate. Markets hang on every word of their statement. But how does the Fed actually move interest rates? Its main tool is open market operations. When the Fed wants to lower rates, it buys treasury bonds, injecting cash into the banking system. More cash means banks can lend more cheaply. When the Fed wants to raise rates, it sells bonds, pulling cash out of the system. Less cash means banks charge more to lend. Supply and demand applied to money itself. The Fed has 2 other tools. The discount rate is what the Fed charges banks that borrow directly from it, acting as a ceiling. And reserve requirements determine how much cash banks must keep on hand, though this tool is rarely adjusted today. Here's where it gets fascinating. When the Fed changes its rate, the effects ripple outward like waves. Mortgage rates move with it, making homes more or less expensive. Savings account yields rise or fall. Stock prices react, often violently, and the US dollar strengthens or weakens against other currencies. Lower rates mean cheaper borrowing. Companies invest, consumers spend, and asset prices tend to rise. But too low for too long can fuel inflation and bubbles. Economists have tried to quantify this balancing act. The Taylor Rule, proposed by John Taylor in 1993, gives a formula for where rates should be based on inflation and the output gap. It's not a law, but a useful guide. The formula says the target rate equals the real equilibrium rate plus actual inflation plus half the inflation gap plus half the output gap. Simple in theory, incredibly complex in practice. Looking at history tells a powerful story. Rates peaked above 20% in the early 1980s when Paul Volcker crushed inflation. They gradually declined for 4 decades, hitting near zero during the 2008 financial crisis. Then came COVID-19 in March 2020. The Fed slashed rates to near zero overnight and launched massive bond buying. This fueled the everything rally, but it also planted the seeds of the inflation surge that followed. By 2022, inflation hit 9%. The Fed responded with the fastest rate hiking cycle in 40 years, raising rates from near zero to over 5% in just 18 months. It was a shock to markets and homebuyers alike. Now in 2026, with inflation gradually coming under control, the Fed has begun carefully cutting rates. The current target range sits around 4 to 4.5%. Markets are watching every data point, trying to predict the next move. So what does all this mean for your money? When rates are high, lock in savings rates and be cautious with debt. When rates are falling, it can be a good time to refinance and invest. The key is understanding where we are in the cycle. Remember, the Fed doesn't control the economy directly. It controls the cost of money, and through that single lever, it shapes the financial lives of 330 million Americans and influences markets worldwide. Understanding the Fed is understanding the single most important force in finance. Now you know how the machine works.